Thank you, Mr. Chairman. You know, in the last administration, prudential regulation drifted away from its core statutory mission of protecting safety and soundness towards subjective judgments and political priorities. That shift has caused created unnecessary uncertainty and imposed disproportionate burdens on the community and mid-sized institutions that drive credit formation. We're now working to revive that principle of regulatory tailoring because requirements should match an institution's actual risk profile. Comptroller Gould, the OCC has proposed reducing exam frequency for smaller banks. The House has also passed a bill that I sponsored, the Trust Act, which would raise the consolidated asset threshold for well-managed community banks that qualify for an 18-month exam cycle from $3 billion to $6 billion. How do you think that will improve the capacity without compromising safety and soundness?
Well, sir, first, thank you for your efforts on the legislative front. Obviously, we can do what we can on the regulatory side to make some of these changes, but you can make them permanent. So thank you for your willingness to push that. I think the reality is simply that as we've seen, particularly post-2008, a lot of the burdens of the post-2008 crisis regulatory and supervisory framework fell disproportionately on smaller banks, really imperiling their business models. And so anything we can do to kind of alleviate that, and I think anything you can do through statute would be well taken by those banks. The reality is that, I think that we have been, at least at the OCC, have not been allocating our examiner resources in all cases that is in a way that is proportionate to the risks presented by the actual banks, particularly smaller banks. So I think again, I'm not familiar with all the details of your bill, sir, and happy to look at it and get back to you, but I think it sounds like what your bill would do would help us kind of constrain that.
Great. You know, one-size-all regulation has really distorted competition and discouraged institutions from growing past these arbitrary thresholds. Recognizing this need, the committee also passed the TIER Act to update the statutory tailoring thresholds and require federal banking agencies to periodically review and adjust the non-statutory thresholds as well. Vice Chairman Bowman, you've emphasized the need to strengthen tailoring across categories 2, 3, and 4. What specific changes is the Fed considering to ensure mid-sized and regional banks are not subjected to capital and liquidity requirements that exceed their actual risk?
Well, thank you very much for that question. And as we very thoughtfully considered those thresholds within the capital rules that we introduced back in March, one, we're looking forward to comments to see if we've got the balance right on how we're applying the standardized approach to the non-GSIBs throughout the banking system. But we're also approaching the way that we're thinking about applying applications beyond capital as we're looking at asset thresholds throughout the entirety of the banking system. That would include the larger banks as well as the smallest banks.
Very good. You know, tailoring just isn't a bank issue. Chairman Hopman, what steps is the NCUA taking to ensure regulatory tailoring for rapidly growing credit unions that may not resemble traditional models?
Sorry. Just in the past year and a half, we've done a true top-to-bottom review of a lot of regulations, some of which were outdated, some of which were counter to each other or redundant. We know that even just complying with them, doing the paperwork, is an epic hassle, but we definitely want different kinds of credit unions. As an insurer, you want a diversified portfolio. We want them to do different things. So that's something that has been a struggle, but trying to have our examiners aware that doing new things in a different way is positive as an insurer. We don't want credit unions to look like each other.
Last November, committee Republicans sent a letter to the federal banking agencies to ask that you undertake rulemaking to index the regulatory thresholds for the application of enhanced prudential standards, which are based on 4 categories of institutions. The Senate Banking Committee sent a similar letter earlier this year. Back in 2019, your agencies indicated that they plan to reevaluate these thresholds periodically through the notice and comment process, but that hasn't happened since they were originally sent 7 years ago, which underscores the need to index these thresholds moving forward. Looking at how the scope of the new Basel III proposal is limited to Category 1 and 2 institutions, it's clear the agencies will continue to rely on the EPS categories and other prudential regulations, which further highlights the need for indexing. So, Vice Chair Bowman, you've given many speeches and testified before this committee in support of adjusting these kinds of fixed thresholds, and how, in the absence of indexing, firms with stable growth and no change in risk profile can cross asset thresholds and become subject to increasingly complex regulatory requirements and supervisory expectations. I believe Chairman Hill actually asked you about this when you testified last October. So can you give us an update on timing for when you and the other agencies will go through rulemaking to index the EPS thresholds?
We're currently working on that, hopefully in the near future.
Okay. Any idea of a timeline?
I really don't want to commit to a timeline because I have a board that I have to.
Gentleman's time has expired.
Understood. Thank you. And with that, I yield back, Mr. Chairman.
Thank you.